So in a recent video, I addressed Trump accounts because they've been discussed widely in the press, and we've received a lot of questions from clients about, should I open a Trump account? How can I open a Trump account? Does my child qualify for the government contribution? What I want to zoom out on and talk a little bit more about is the types of accounts that are available for investing in your child's future and where the pros and cons exist, because we get a lot of those questions. And I think really they're the better questions to be asking from clients all the time. Should I invest in a 529? I've heard this or that. Should I invest on my own in a different type of account that does not have restrictions? What are the pros and cons of that? I find that there are lots of mischaracterizations. There's a lot of bad and false information out there, or premises that are not even true about the types of accounts. So let's get into it. As it stands today, if I am an American citizen and I have a young child that I want to invest money for, there's essentially, I'm going to boil it down to 4 simple options. If you exclude things like real estate and maybe other sort of more esoteric ways to invest for your kids, there's essentially 4 types of accounts that you could put money into. There is a 529 plan, which a lot of people are familiar with. That is your college savings account, although the uses of 529s have expanded. I'll touch on that in a second. There is what are called UTMA accounts, which is an acronym for the Uniform Transfer to Minors Act, which is a mouthful for what is simply a brokerage account, an investment account for kids that are minors at age 18 or 21, depending on the state. They take ownership of the account. It becomes their account to do whatever the heck they want to with it. No restrictions, no specific uses or funding cases for that, the way 529s are set up. You have the ability in theory to just invest money in an account that you own, as I own as a parent, let's say, that stays in my name, but I could be mentally compartmentalizing that money to be used for my child in the future or to gift to my child in the future. Pros and cons of that as well. And then there's the new Trump accounts, because I just recorded a separate video on the Trump accounts. I won't touch on a crazy amount there. I'll just use some of the rules to give it a relative comparison. So let's think through, if you have a young child, what ultimately many people often are thinking about. What if my child goes to school? What if they don't? Those are probably the 2 biggest ones that I think we hear about. And I find when people anchor towards that second question, what if my child doesn't go to school? They immediately think, well, then there's no reason that I should have a 529. And in life, as I think we can all agree, every future outcome is sort of based on current probabilities. Like, what is the probability that your child is going to go to school? Is it a 0% chance? Is it a 100% chance? It's probably something in the middle, depending on what your goals for your child are as well. Most people agree when I pose that question to them that it's not a 0% chance. And when you think about the cost of education in our country, and the exorbitant amount of savings that you likely need to have to be able to fund a college education for your child, if there is a non-0% chance that your child goes to school and they are young, putting some amount of money into a 529 is probably not going to be the worst idea. You're probably not going to have a ton of regret for having done that. I find very infrequently do people actually have the full amount of money that they need to fund when their child does go away to school just in a 529, which means starting early and having something in there is going to be better for if that outcome does come to fruition. So just to maybe dive a little bit deeper into that too. 529 accounts, as we can think about them, like one of the reason why that they are so well suited for college savings is the tax rules around them. A parent puts money in the account, the earnings in that account grow tax deferred, tax free essentially if it's used for college, so that you're not inhibited and the growth of the account isn't inhibited by taxes along the way. And then if used for qualified education purposes, of which there's a broad definition for, that can be found on a variety of resources, tuition, fees, room and board, meals, all kinds of different college costs. If they're qualified, you can take tax-free distributions from that account. So if you're growing money for the use of college, a 529 is going to be far and away the best account that you can possibly use. They are state sponsored. So when you're opening a 529, you're technically opening an account with that is sponsored by a specific state. Every state has a variety of tax rules that are important to consider that we can help clients work through, depending on whether they're a resident of that state or they're using a different state's 529 plan. But in essence, the federal laws govern them exactly the same. Tax deferred growth, tax-free withdrawals. A few of the beautiful parts of a 529 as well is they do have some flexibility. A lot of people think of 529s as no college, no use case. Where I push back on that is that 529s, number one, they can change beneficiaries. So you have multiple kids, and the sort of easy example there is one gets a full scholarship or one doesn't go to school at all. The other 2 go to a really expensive school, and you save money for all 2 or 3. you could transfer that balance from the child that's not going to be going to school or doesn't need the funds anymore to someone else who does, which is a really nice benefit. They've also expanded uses for 529s in recent years with legislation. You can use them for trade schools. You can use them for technical schools. You can use them for private schools before college. You can use them on a limited basis. You can also use them now for certain certifications. So if you want to become a certified financial planner, that is a certification in theory that you could use unused 529 funds to pursue a professional certification like that, a CPA designation, a CFA designation. The other big rule of 529s that most people have started to hear about in recent years, which came from a recent legislation change as well, is unused funds in a 529 account can now be converted to a Roth IRA for that same beneficiary up to a lifetime maximum of $35,000. So if you had a 529 account with $35,000 on the dot left in it, that was never going to be used for that child to go to school or any other children to go to school. The way the rule works is over a handful of years, you could convert that $35,000 into a Roth IRA for that same beneficiary. And that money is essentially a wonderful retirement gift, if you will, for that same beneficiary now within the confines and the benefits of a Roth IRA. So that also helps take some of the air out of the argument to not use a 529 in case your child doesn't go to school, because you do have some flexibility there. Not to spend all of our time on 529s, but one other important note on 529s that I find to be, again, something that is misunderstood. If you do not use a 529 for college expenses and you just withdraw the money, you don't convert it to a Roth IRA, you just take all the money out. There's a 10% penalty that applies, and ordinary income taxes apply. Both ordinary income taxes and a penalty apply to just the earnings portions. It does not apply to the money that was contributed to the account. So in an example where you have $100,000 in a 529 account, never going to be used, you want to withdraw all of that. Let's say that person contributed $60,000 of that 100K balance out of their pocket. Those were $60,000 worth of contributions. That $60,000 is going to be returned to that person with no tax implications whatsoever. There's no income tax, there's no penalty. The remaining $40,000, which would be earnings in this case, is what is going to be taxed at ordinary income rates, and it will have a 10% penalty tax. Obviously, you want to avoid that outcome, although one of the potential math problems to consider is if your child is 1 year old and you invest that much money between 0 and the time they turn 20, let's say, it grows to $100,000 in that example. That entire 20-year period, you did not pay any taxes along the way. The money grew faster, it compounded faster because you didn't pay capital gains taxes, dividend taxes, interest taxes. So if you get to the end and you're not going to use it for college, you withdraw it, you pay ordinary income taxes and you pay a 10% penalty. Not in every case, but in some ways, you would have lost some of that along the way anyway if it were in a different account and you were paying capital gains tax or dividends or interest. So that takes some of the bite out of the 529. So now we're going on 9 minutes, just to touch on a couple other items. 529s have a broad use case and they are by far the best place to save money if you think your child has a chance of going to college. The UTMA is probably the second most common type of account to think about and utilize when investing for your child's future. Again, all they are brokerage accounts, investment accounts. They do not have pre-tax, post-tax rules. The money goes in, there's no contribution limits. The big distinction there is, again, the ownership of the account transfers automatically to that child when they turn, again, usually 18 or 21, depending on the state that you live in. That is different than a 529. The 529 never will transfer directly to the beneficiary, unless you do that with intention, which means you control. The person that started the account, the parent, controls the money in that account always. With a UTMA, you only control it until they turn their age of majority. And again, at 18 or 21, most people that I speak with clients when we speak through this, generally agree that that's not a financially responsible age for a kid to just be taking custody of a lot of money. So there's going to be important conversations that probably need to take place between parent and child, or a guardian and child, to understand the importance of that money and what it was intentionally saved for. The biggest consideration around a UTMA investment account for a child. There's some other nuances with a UTMA. You're not going to get the tax deferred growth with a UTMA that you do get from 529. So again, not that any of us are future fortune tellers, but if you in theory saved the same amount of money to a UTMA that you did to a 529, and you ended up using those balances for college, the 529 is going to far and away be the much better tax outcome, because you're not paying any taxes on your gains. You're not paying any taxes on withdrawals, etc., Whereas with the UTMA, you are going to have some of those tax inhibitors, but you get a little bit more flexibility around the use cases for that money. The other option that I always talk to people about is just keeping money in your own name. Opening, let's say I as a parent have my own investment account with my spouse. Let's say maybe it's a joint account, maybe it's a revocable trust, and we invest money for our future in that account. Taxable investment account, I pay my capital gains, I pay my dividends, I pay my interest, all that kind of stuff. In theory, I could just set up another account that's sort of mentally, psychologically compartmentalized for the use of my child. I'm going to save X amount of dollars here. It's going to be separate from the rest of my investments. In theory, it still is dictated by whatever the terms of my estate are. The idea is maybe I have 2 kids or 3 kids or 4 kids, whatever. This is just going to be my pot of money that when they turn a certain age, I can gift to them. I can maybe set them up with certain things. I can use it to pay certain bills for them. Benefit of that is you maintain any and all control of that money. The con is you don't get any tax benefits because it's falling under your name. You're paying capital gains taxes. There's no major benefit to you from that standpoint. And again, if it's going to get used for college, that's where you could maybe kick yourself a little bit because the 529 would have given you better tax outcomes. So that's kind of the array of accounts that traditionally we've talked about for, hey, I want to save money for my kid for them to either go to college or help them start a business or help them start a family or start a life or start to buy a house, whatever. Those 3 accounts are kind of your historically available accounts to utilize. These Trump accounts, although new, exciting, new rules, etc., I would put as a completely separate type of account from those 3 uses. The Trump account, as I mentioned in my last video, is really an IRA retirement account for minors. So the money, if you're using it most advantageously, is going to go into that account, and hopefully your child, the beneficiary, is not going to touch that money until they're in their 60s, basically. Which if you're a parent, you have to think about, if I'm saving money for my child now, I may want the benefit, the satisfaction of seeing them use it during their lifetime or my lifetime. And if they're not going to be using that money until they're 60 or 70, I'm probably 80, 90, or I've maybe passed away at that point. So that is a worthwhile question to ask of all the money I have to save in any given year right now in my working years while I'm saving money for my family, do I want to be portioning off money for my child that is going to get used 60 or 70 years from today? Or am I more comfortable saving money to their college education, their early adulthood lifestyle? If you have the ability to do all of them, great, do it. There's nothing wrong with that, but I think it's important to establish the qualitative goals, understand your savings capacity in any given year, and then marry some of these product and account solutions with what those goals are. That's a very cliche, obvious thing to say, but it is obviously important to map out than just saying, there's a new account. I heard I get $1,000 from the government. Let me throw some money into it. Great. If your goal is to fund law school for your child, the Trump account is not going to help you do that. A 529 is. Or I want to save money so that my child can go to trade school or they can start a business or, buy a house at age 20. Maybe a UTMA is going to be your best bet for that type of account than a 529 or a Trump account. So the qualitative goals are important. We all know that, worth restating. Hopefully no one is rolling their eyes at how long this video is, and hopefully it's a good resource for all of you.